If the super bubble bursts, as you predict it will, what happens? What happens to the economy? What does history tell us?
Some bubbles are very specialized to US growth stocks, like 2000. And they hurt. There is a wealth effect. People lose money, they pull back on their spending. But they don't hurt anywhere near as much as when you combine that with a housing bubble. So in 2008, where we had the only housing bubble in American history, that burst and the stock market came down 50% in sympathy.
What if I'm a long-term investor, say running a pension fund or managing my own 401k, which I should add, I don't. But what if I'm one of those people and I look at history and history tells me that over time, independent or including crashes, stocks deliver a handsome return. And if I just stay in the market, I'll get that return, whether it's 7% or 8% or 9% or 10% over time.
You know, if you could set your dial for 50 years and throw the key away, that might make some sense. But let me remind you that in 1929, you didn't get back in real terms until about 1954. That's a long wait. In 2000, you didn't get back for 13 years. By modern standards, that's a pretty long wait. And in Japan, which is really the granddaddy of both bubbles, land, and stocks, they are not back to their 1989 peak today. That is a very, very long wait. So if you think you can stand it for 10 or 20 or even 30 years, be my guest. But history says a lot of you will not stand it. A lot of you will become more conservative deep into this kind of correction.
And what about the real sour grapes critics, the ones who say you're just a broken clock that's only right twice a day?
We have a relatively humble measure of success, and that is at some future date, if you got out when I said get out, you will be glad. It doesn't mean you won't suffer in the meantime, but at some future date, you will be glad. That worked in Japan. We were very early. But if you'd gotten out when we got out, and you'd suffered as the Japanese market went up, you would still have made and saved a lot of money on the round trip. The same in 2000. We were basically recommending that you ease up on US equities by mid-98. And that was a hell of a rally, and that was brutally painful. But it was still a level where you made tons of money. By 2002, the market was much lower than that.
Why doesn't getting out mean, for GMO included, mean liquidating, going to cash?
I think commercially it's too extreme, to be brutally honest. And secondly, if you can execute the strategy that I described, there is a really respectable chance that you will make money.
You say that the bubble you described back in January of 2021 has further inflated into a super bubble. And I'm curious to know, I think others would be too, what's the difference between a standard bubble and a super bubble?
A standard bubble we defined over 20 years, perhaps 25 years ago, as a 2 sigma statistical event. It's just a measure of how much of an outlier you are. So you have a historical
deviation
series.
From trend.
Yeah, you have a price series of the S&P. You can calculate a trend. Statistics 101 is not difficult, and you can work out how far away from trend you are. And a 2 sigma is the kind of deviation that should occur every 44 years. And because we're a little wilder and less efficient than we should be, it occurs every 35 years. It's not bad.
We meaning human beings,
we being,
as a species.
As a species. Every 35 years. It was a little closer than I expected back then. But every 35 years feels about right. One a career, twice a lifetime. That feels like a pretty decent definition of a bubble. And a 3 sigma should occur every 100 years. Now we, as I like to say, we do crazy pretty well as a species. So they occur much more, 2 or 3 times more often than they should. They're out of kilter much more than 2 sigma. So 2 sigma, you can have some fairly standard bubbles. They give you a certain amount of pain, 30, 40, 50% pain. Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. So this is a very dangerous year that we've just had.
If the super bubble bursts, as you predict it will, what happens? What happens to the economy? What does history tell us?
Some bubbles are very specialized to US growth stocks, like 2000. And they hurt. There is a wealth effect. People lose money, they pull back on their spending. But they don't hurt anywhere near as much as when you combine that with a housing bubble. So in 2008, where we had the only housing bubble in American history, that burst and the stock market came down 50% in sympathy. Then you're talking serious damage to the economy through the income effect. Because this time we have, as a multiple of family income, US housing suddenly is more overpriced than it was ever in the housing bubble of 2006 to 2008. And it got there this last year since we last spoke. The biggest increase, 20%, that the US housing market index has ever had has taken it to a new high. And they are, in the US, still much cheaper than Canada, Australia, New Zealand, London, Paris, etc. So that is a global event that could cause enormous pain. So we have a housing problem, we have a stock market bubble like 2000, we have overpriced commodities, oil is 88, and we have, of course, the lowest real rates in the history of man.
If bonds are overpriced and stocks are overpriced, does that make the traditional 60-40 balanced portfolio useless?
Absolutely useless.